Hello again. Welcome to part 2 of our discussion of chapter 13. Specifically, we're getting into the second topic in this chapter, and that's the alternative minimum tax. So this is a separate tax system that requires us to go through a similar formula as a regular tax, except that we have a different sets of deductions to try to minimize the impact of certain deductions that are common amongst those who are of the higher incomes. So this is theory to try to make the tax law and the tax rules more fair. What ends up happening is you have to calculate your tax twice, once using the regular tax system and once using the alternative minimum tax system. And what you do is pay the higher of the two. What that usually means is the AMT, or the alternative minimum tax, is an add-on to the regular. So you've calculated them both, then the difference, or the amount that the AMT is over the regular, is added as an additional tax on the 1040. So how do you go through this process, this separate calculation, if you will? Well, you start with regular taxable income, and you see the formula on the slide. Then you don't count standard deduction or any exemptions from past years. Okay. Then there's some adjustment items, some tax preference items. These are deductions that are different under the regular tax system than they are under the alternative minimum tax system. So we have to look at the differences. And those go on this Form 6251 that we'll look at the end as to calculating what this your taxable income is under AMT. All right, so you do that. You subtract a flat AMT exemption amount. So instead of all these different deductions and things, you get this one exemption amount. Then you get your AMTI, or alternative minimum taxable income. You multiply that by 26% or 28% less the 3958. Okay, on the income, if your income is over the threshold, and then you look there, like I mentioned earlier, you compare that to the regular tax, and then the difference is the add-on AMT. If your AMT is lower than your regular tax, you can ignore it, and you don't have to worry about it. So what adjustments need to be made? Well, one of the things that we'll see on the 6251 is that the only real difference on itemized deductions now that we've changed the law having to do with medical and mortgage interest, charitable contributions, miscellaneous deductions, now the regular and the AMT are pretty much the same. So there used to be different thresholds. Used to be that miscellaneous deductions, itemized deductions, were not allowed for AMT, but they were allowed for regular. Now they took them away under regular, so now it's the same. Mortgage interest on a second loan had to be used for fixing up your house to be deductible under AMT, but not under regular. Now that's the case under regular, so regular and AMT are the same. So there's been changes to both the regular and the AMT, and what's happened over time is they become more the same than they are different. So what really comes down to is how much the taxes are. So state and local income taxes, property taxes, all of those local taxes are the ones that are limited to $10,000 we learned about in Chapter 5. That is really the only adjustment. So you'll see that the 6251 form has you either, if you itemize, to add back the amount of taxes. And you only have to add back the amount that you deducted, so it wouldn't be any more than $10,000 because that's what its limit is on taxes. So that is simpler than it used to be, and it's not. So you're looking for that lots of income taxes on the local level. There are some depreciation adjustments. So from Chapter 6, we learned how to calculate depreciation. Much of this, like we mentioned in Chapter 6, has gone away because there is no difference with regard to the bonus deductions or the Section 179 deductions in terms of depreciation. But regular depreciation deductions, especially the further back you go, there was quite a difference in how much depreciation you could take for regular tax versus AMT. So you'd look at the two and you'd have the difference. This is what your depreciation would be under regular tax. This would be on AMT. The difference would be what you put on this Form 6251. If there is a difference in depreciation, then there's also going to be a difference in the basis when you go to sell it and how you calculate the gain or loss. So those carry forward that arises because of the difference in the depreciation. There is another one called the incentive stock option adjustment, which says when you receive incentive stock options, that's the option to buy stock at a set price. We give it to employees as kind of a reward, extra compensation. What happens is if they have an option that they can buy the stock for less than it is selling for, okay, so if they can buy it at 20 when it's actually worth 30 in the marketplace, then that $10 difference is an adjustment for AMT, because that difference is not income under regular tax, but it is under AMT. So you have to look at the difference. Okay, there's some that will come from our K1s from businesses because they have different gains or losses, or those businesses have different depreciation methods, and so those pass through to the shareholders. And then how we account for our long-term contracts, we won't go into it. Okay. This list used to be much longer, and these things have gone away over time, either been treated differently under regular tax or have been dropped out of the AMT list. So once you've got those adjustments and so forth, then you have exemption amounts. Remember, there's one thing is exemption. So basically, these are the amounts under, if your income is below any of these amounts, based on your filing status, AMT is not going to be different. It's not going to affect you. Okay? These exemptions then are subtracted to get your taxable income and calculate the tax. These exemptions are also phased out, and they used to be phased out fairly at much lower numbers. Now they're not phased out to the limits you see there at the bottom. That's a pretty high limit. So they don't disappear. They go down by 25% of the amount over it. So if your income is over $518,400 as a single filer, then whatever your income is over that, take 25% of that and then subtract it from your exemption amount, and that's your new exemption amount. And so at some point, the exemption amount disappears altogether. Remember, the tax rate for the AMT is 26 and 28. Regular tax rate is can be as high as 34%. So at the very highest tax rates, the AMT is actually lower because it's a lower rate. There are fewer deductions, but there's a lower rate. So it doesn't usually affect people at the very highest parts of income because they're already paying a much higher rate than the AMT. Okay, we'll look at the form real quickly here. This is the 6251. Notice that where it starts with is taxable income. We add back either the taxes or your standard deduction, and then these are the others. You can see that the list is a little longer than what we gave in the slides and it's given in the book. But we gave you the most common ones. These are adjustments to the income till we get to our alternative minimum taxable income. Then we subtract out the exemption. Okay, and if you get less than 0, then you're done, right? Okay, because none of it is taxable. But if you get a positive number, calculate your tax. Okay, notice the tax bracket is up to $197,900 married filing jointly, $98,950 filing separately. Okay, and this is the formula of how to calculate that. We won't have any alternative minimum tax, foreign tax credit. That's more complicated than our class. And this is our tax. We compare it to our regular tax on line 10, and if it's higher than the amount on line 11 is our AMT, and that goes back on the 1040.